Welcome everyone to another Chapter 3 video. This one covers Learning Objective 4. Compute underapplied or overapplied overhead cost and prepare the journal entry to close the balance in overhead to the appropriate accounts. So this is something we've been hinting at really since back in Chapter 2, this idea of underapplied or overapplied overhead. And now we're going to put the rubber to the road and actually do something about it. So let's keep in mind why we can have overapplied or underapplied overhead. We were applying overhead in our job order costing system on the basis of those predetermined overhead rates, right? And those things were based on pre-period estimates. So since they were based on estimates that happened so far in advance of actual operations, it's not very likely that applied overhead is going to ever equal exactly, anyway, actual overhead incurred. So we could have underapplied or overapplied overhead. Underapplied overhead just means that we applied less than we incurred. Overapplied is the reverse. We applied more than we incurred. Either way, we've got to clean that up. So we also want to keep in mind that we're trying to think of whether overhead is underapplied or overapplied. We want to be comparing actual overhead incurred to total applied overhead for the period. We don't care about our estimated overhead for the period anymore. Just want to focus on actual overhead and applied overhead. So let's look at an example here. Let's say Pearco, our favorite for examples, has actual overhead for the year of $650,000 and worked a total of 170,000 direct labor hours on jobs in that same period. Now their predetermined overhead rate is $4 per direct labor hour. So if we want to come up with total overhead applied during the period, we've done this before, we're going to take that predetermined overhead rate of $4 per direct labor hour times the actual number of labor hours used or worked on jobs of 170,000. So $4 times 170,000 means total applied overhead of 680,000. We can already start to see where this is headed, right? Applied overhead is 680,000. Actual overhead was only 650,000. So we are over applied by the difference, by $30,000. 680,000 minus 650,000. So over applied by 30,000. What are we going to do? Well, we're going to dispose of this over applied or under applied overhead into the cost of goods sold account, or we could close it proportionally to work in process, finished goods, and cost of goods sold. Okay, two possible options here that are observed in practice. The first actually tends to be more common, even though it's the simpler method. So let's try one out here. Pearco had 30,000 in over-applied overhead. So if we're closing this all out to cost of goods sold, we would have a debit to the manufacturing overhead account for 30,000 to get that balance to zero, and then a corresponding credit to cost of goods sold for the same 30,000. And I've illustrated that in the T accounts here as well. Basically, we want to keep in mind that whatever balance this overhead account has at the end of the period prior to an adjustment, we need to clear it out. So in the case of over-applied overhead, that means we're going to have more credits than debits, at least pre-adjustment. In this case, Pearco, we see that with the example, they were 30,000 over-applied. So we've got to do to this overhead account whatever we need to get it to zero. So if it has a credit balance of 30,000, we need debits of 30,000. If it's got a debit balance of 20,000, we'd need a credit of 20,000. Okay, so just need to close that out. And if we're closing it just to cost of goods sold, we're just going to do the exact opposite to that cost of goods sold account. So we had the debit to overhead of 30,000 here to get it to zero. That means we're just going to have a matching credit to cost of goods sold for the same 30,000. Also worth keeping in mind that this $30,000 credit to cost of goods sold, since cost of goods sold is an expense account, would reduce that balance, would be decreasing in expense, which would have an effect, a positive effect, in fact, on net income. Now we can also divvy this under-applied or over-applied overhead up to work in process, finished goods, and cost of goods sold. The reason a company might do that is because it may be a better reflection of where those manufacturing costs currently are. Because if we think about under-applied or over-applied overhead, it really comes about because of the way we've been applying overhead using that predetermined rate to production throughout the period. So it may be a little more accurate to divvy that difference up between those other accounts. The work in process inventory, the finished goods inventory, and then some to cost of goods sold. So let's assume for a second that the current overhead cost applied already in ending work in process, finished goods, and cost of goods sold is respectively $68,000, so that's in work in process, $204,000 in finished goods, and $408,000 to cost of goods sold for that period. So a total of $680,000 if I add up the three. Now what I want to do if I'm disposing of this overapplied or underapplied overhead proportionally to those accounts is figure out what the percentage of the total cost each account represents. So ending work in process in this case was $68,000. That's out of the $680,000 in total cost, or 10%. The finished goods had $204,000 in overhead cost, divided by the $680,000 total, or 30%. And then cost of goods sold had $408,000 in overhead cost flowing to it this period, divided by the $680,000 in total, or 60%. These are the proportions I'm going to use to divvy up that over-applied overhead in the case of Perco. Okay. So what I do is I take that $30,000 in over-applied overhead and I just multiply it by those percentages, by those proportions, to get the amount that I'm going to send or dispose of to each individual account from that over-applied overhead. So work in process had the 10% of total overhead cost. So I'll take 10% of 30,000 or 3,000 and dispose of this over-applied overhead there. Finished goods had 30% of the total overhead cost. So I'll dispose of 30% of this over-applied overhead there. 30% times 30,000 is 9,000. And then cost of goods sold had 60%. So 60% times 30,000, there's my 18,000. And I'll just double check to make sure I'm accounting for all 30,000. Now the entry disposed of the over-applied overhead then would look fairly similar to our first more simple version. We'd still have the same debit to overhead of 30,000. I still need to get that account to zero no matter what. But now I'm crediting work in process for 3,000, finished goods for 9,000, and cost of goods sold for 18,000, rather than the cost of goods sold for the total entirely. Okay, so there's our second method. Again, you are going to see both, or potentially would see both, I should say, in practice. The simpler method sometimes works perfectly fine for firms. So to wrap this up real quick here, there are the two methods, the closing out either directly and entirely to cost of goods sold, or allocating between work in process, finished goods, and cost of goods sold. Those other kind of sources, if you will, of manufacturing or overhead costs during the period. Bottom line is, we want to make sure we do whatever we need to get the overhead account to zero. If we want to think about the T account here, again, actual overhead on the debit side, applied overhead on the credit side. Whatever this pre-adjusted or unadjusted balance is, in the case of Perco, it was 30,000 on the credit side. We just need to do the opposite to it to get it to zero. Overhead's a control account, needs to be a zero balance at the end of the month. Then we'll worry about whether we're closing it all to cost of goods sold or splitting it up proportionally between work in process, finished goods, and cost of goods sold. Okay, let's try an example here. So Tiger Inc. had actual manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour. Tiger Inc. worked 290,000 machine hours during the period. Tiger's manufacturing overhead is either 50 or 60,000 over applied or under applied. Pause this, work through it, and then I'll have the answer here. So the answer there is 50,000 under applied, letter B. So remember, over or under applied overhead, we want to compare applied overhead to actual overhead. Don't care about the estimated overhead anymore, even though we didn't have it here anyway. Overhead applied for this period, our predetermined rate of $4 per machine hour, times the actual number of machine hours run or worked this period of 290,000, gives me applied overhead of 1,160,000. That's applied of 1.16 million versus actual overhead of 1,210,000. So I've applied less than I incurred. I've got to be under applied. So take the difference, 1,210,000 minus 1,160,000, and there's my under applied overhead of $50,000. All right, think about this for a second. What effect will the under applied overhead have on net operating income? In other words, when we adjust here at period end, what's going to happen to net income? Will it increase, be unaffected, or decrease? Think about that for a second. I'll have the answer here. It would decrease. And we just want to go ahead and think about our journal entry if we need to. If I adjust for this under applied overhead, I would need a credit to overhead for, let's say, $50,000 if I was under applied by $50,000 from our previous example. I'd have a corresponding debit to cost of goods sold for $50,000. A debit to cost of goods sold increases that expense account. So if I increase expenses, I'm decreasing net income on the other side. And that wraps up this part of Chapter 3. Feel free to back up and revisit any piece you need to. And as always, let me know if you have any questions.